Hello, Scott. Good to see you. Welcome to the ETF Edge portion of Halftime Report. Active management is making a comeback in the ETF space as many active mutual fund managers convert to an ETF model. But the big sector rotation this year is increasing interest in one area of active management, and that's market timing. Can you successfully move in and out of ETF sectors and make money? Let's talk to Kim Arthur. He runs the main sector rotation ETF. The symbol is SECT. Wes Krill is the Vice President of Research at Dimensional Fund Advisors. He's been studying the market timing efforts for decades. Kim, your sector rotation ETF moves in and out of ETF sectors, not stocks. It's outperforming the S&P 500 this year. You've got heavy bets on banks, energy, and small cap ETFs. Now, how do you decide when to rotate this portfolio?
Hey, Bob, good to see you. Thanks for having us on. Yeah, that's a great question. So what we look for, Bob, is we look at a lot of historical data. We want to have a big sweep of the valuations because we think that valuations do matter. And it's not only valuation, though. You have to have a catalyst that goes along with that valuation. So as you mentioned, since the 1st of September, there's been a massive rotation into value, size, and being small cap and cyclicals. And that's because that was when rates bottomed. At that point, people realized we weren't going to have a double dip. And the catalyst for the value component is coming out of a recession, steepening yield curve, and getting a situation where you start to have positive real rates. So we, as you said, we have about half of our portfolio now that's in those cyclical value size components right now.
Okay. And Wes, Dimensional Funds has spent decades studying what works and what doesn't work in overall investing. Could you tell me, is there any evidence that market timing will, like the kind that Kim is doing now, actually works long term?
Yeah, thanks, Bob. I'd like to start off with a little statistic here, which is in 2020, the average daily trade volume in equity markets alone was over $650 billion. So that represents a lot of buyers and sellers coming together and setting prices. And that's kind of what you're up against when you attempt to outguess markets, whether it's picking individual stocks or just trying to predict which segments of the market are going to go where at what particular time. And so consistent with that daunting proposition for investors, we have about half a century of evidence, both from academics as well as practitioners, to show that by and large, investors are not able to consistently outperform markets by either picking stocks or trying to market time. And so that's an important thing for investors to keep in mind. It also brings about potential opportunity costs. We know that the long-term rate of growth for the market has been spectacular over long periods, but missing out on some of the best days in the market, if you don't get that timing strategy perfectly well calibrated, could potentially have a deleterious effect on your overall growth of wealth.
Okay, thanks very much, gentlemen.